Welcome to Decoding Retirement. Hi, I'm your host, Bob Powell, and today I'm speaking with Chris Ceder from Goldman Sachs. Chris, welcome.
How are you doing?
It's a pleasure to have you here. The topic of the day, Chris, is a big survey that Goldman Sachs just released, and I would love for you to start with giving us the big takeaways from that report. I think the first takeaway was this notion that the financial vortex is on the decline.
Yeah, no, appreciate the time here. Thanks for having me. We do an annual report. We survey about 5,000 individuals, so we have a very robust set of data. What we're really interested in learning is, how well people are managing what we call that kind of that financial vortex, because it's really about competing priorities in terms of that impact, how people can actually save for retirement. And this is really the first year that we've seen really a decline in people saying that things like saving for college or credit card debt or other competing priorities is actually on the decline this year. We also see that people still feel that those competing priorities are going to delay their retirement. So really one of the takeaways was things are improving, but we still see room for improvement because, again, being able to retire on time is just one of the core things that we really hope for people.
Yeah, so if memory serves, I think it was somewhere around 60% of people said that they were going to delay retirement because of these competing demands.
That's right. So again, still the majority of people feel like these competing priorities are really going to basically have an impact. And again, different timeframes. But not being able to retire on time, continues to be a really core challenge for people.
Yeah, I would like to mention there was a survey done out of Stanford where they looked at how someone could improve their retirement security, whether it was by investing more or investing more aggressively or saving more. And the conclusion that they came to was that by working 2 years longer, greatly improved their chances of improving their retirement security. So maybe it's not a bad thing to delay retirement?
Yeah, no, 100%. And I think for the most part, a lot of times when people feel as though that they are behind in their savings, like their answer is, well, I'm just going to have to work longer. The problem, and we see this again through our survey results, and this has been consistent over the last several years, is that 50% of people actually retire before that they planned. And very few people, like order of magnitude 3 to 4%, are actually retiring after they felt that they were initially going to need to plan to retire. So the challenge is, yes, people think that they're going to be able to work longer to shore up their finances, but the reality is if you have to retire earlier, that has a really significant impact on your ultimate retirement savings.
Yeah, I think the Employee Benefit Research Institute study has said that it's a bad plan B to think that you'll continue working after your planned retirement date, because I think in their study they said only 50% of people were able to continue working.
Exactly. It's very similar results. We're at 50% of people retire earlier than they want. And again, there's populations within that are retiring 10 years earlier than they expected to for things like medical issues, or they're not be able to work because of some disability. So it is very difficult to have a plan in my mind to say that we're going to work longer to shore up finances. Although some people, again, if you're a self-proprietor and you say, I'm just going to continue to work and I'm going to just scale it back, like those are great options. It's just not everybody has those options.
Right. So in your survey, one of the things that you mentioned, and I think the Employee Benefit Research Institute has mentioned this as well, is that personalized planning and advice can greatly improve outcomes, which in some ways is not a big surprise per se, but it's worth noting.
Yeah, no, again, I think when we talk about it, it's, people are like, oh, yes, of course, planning, like that's helpful, right? And, the short answer is yes. I think when we sort of looked at this, it was really the magnitude of all the different ways that planning aspect helped. We actually asked people, a fairly basic question, do you have a personalized plan that tells you how much you need to save for retirement and how to save and invest to reach that goal? Right, fairly basic. And basically we can sort of bifurcate all of our results based upon whether you say yes or no to that. And you look across the board and, whether it's people feeling more comfortable in how they manage their savings, they're less stressed managing their savings, they're able to navigate competing priorities and get to retirement without having to delay. There's really a whole host of reasons that plan comes into play as being beneficial. And on some level, as we talk in the report, it's not just about that plan, but it's about actions that plan is a catalyst for. So it's not so much you do that one thing and all of a sudden you're done, but really that plan is really the starting point for how do you actually manage your savings in a more intentional way, having goals along the way, making sure you're reaching those goals. That is really critical in terms of how we think about planning. And the other reason I sort of highlight it is because on one hand, while we say that people have a plan, a lot of people don't. there's a vast majority of people who don't have access to planning resources, and that's very much core to what we're trying to, articulate and demonstrate the value of the plan, because we really think it's something that's available for all people.
Right. I mean, for most people who are 401k plan participants or 403b or 457, they have access to tools from their employer or from the right to access those planning opportunities.
Right. And it's a mix. Some do and some don't. And so some folks don't necessarily believe they may have, features in their plan like a target date fund where we have sort of professional managed portfolios within the program. But it comes back to the planning aspect of it. Tools, yes, are helpful and people can access those tools, but we need to make sure that people can take those tools and really make a personalized plan out of that. So how do we then account for things that are going on in the individual's life? Do they have a spouse? Do they have other assets? Do they have family members that they're taking care of? All of that becomes part of it, and it's also something that is not a one and done, right? Like that changes over time. If you're 25 and you're thinking, yes, maybe that basic plan is the right place to start, but then you're in the heart of your career, you have family, you have events that you're doing, you may be part of that sandwich generation where you're taking care of children as well as elder family members. How that plan evolves and grows is really important, but I kind of come back to what's most important in my mind is having that planning mentality. I almost view it as a behavior that really will sort of evolve and grow as your life changes, but always keeps an eye towards what you need to do for the future.
Yeah. So at its most basic level, the plan might be how much do I need to save for retirement? How much do I need to save annually? What return do I need to earn on my money in order to reach that goal? Is that it at sort of its most basic level?
At its most basic level, yeah, like that's the starting point. But then what that allows you to do, it allows you to make more informed decisions. So, if something comes up and I need to, take, 4 years out of the workforce for caregiving, we talk about caregiving a lot. There's going to be an impact on your overall retirement savings. What are the adjustments that we made? Without having that information, you really can't make informed decisions about what adjustments should I be taking. Should I save more early before I go on that leave? Do I need to be more aggressive, for the next several years? So it really gives that framework to making informed decisions. And what I, fear is that a lot of people don't have that information. And so the decisions that they're making is, well, we'll solve that in the next 5 years, or we'll solve that later. And when you wait that long, all the changes that necessarily need to be made are only going to be more painful. They're going to be more impactful. So the earlier we can get to those decisions, the better we are.
Yeah, I often think that the mistakes that you make, you won't know that they're mistakes until it's too late to correct them.
The worry is that you wait till 50 and 55 and beyond to say, oh, now I really need to figure out what this is going to look like. And if you didn't really have a game plan before that, you're probably going to get into a situation where, you could be saving 20, 30, 40% of your income to ultimately get to where you need to be. And that has a huge impact. I mean, maybe you wanted to, help your grandchildren for, say, go to college or something like that. So you really limit your options when you don't basically take those early steps, because so much of it now has to be anchored and focused on retirement.
Yeah. So when you think about the advice, education, guidance that plan sponsors and plan providers are trying to give to the plan participant, they typically have eyes only on those assets and maybe not the assets that are outside of that 401k plan, Roth IRAs maybe, or traditional IRAs, or income property, other income producing or asset creating opportunities. What should they do in those circumstances?
Yeah, no, that's right. And, I think the 401k plans, while as great as they are generally limited to what they know, which is they basically know the account that, you have access to. More services are being offered where actually there are ability to sort of integrate your plan, your finances and your 401k with other items that you have. Spousal information, hugely important. Again, whether there's inheritance in the mix, that's also obviously important. Things that you might be considering. So how do you actually get a picture where you actually have a better sense as to all the pieces? You may have a rental property. You may want to have a rental property in the future. Where the income is coming from and how that's going to basically deliver is really, we might call it the holy grail for retirement, because again, that's what we're really trying to solve for. We talk a lot about how personalized retirement planning really is, and it's really for this notion. So, someone who's 45 may look very different if they've been saving for the last, 20 years versus someone who hasn't saved or had medical issues and had to take loans. So how we actually can move people through the process is really about understanding where we are today, what decisions do we want to make to improve that over the next several years? And then as you get to retirement, it's even more personalized because now we're thinking about spousal insurance, spousal benefits, Social Security, Medicare, co-living arrangements, how all that kind of will play out, potentially moving to another location. Very individualistic, but really requires some thought.
Yeah. So when you think about the need to be personalized and individualized, a lot of times people say, I don't have assets that would merit me going to a financial advisor, right? And oftentimes, sometimes financial advisors say, well, you don't meet my asset minimums. So, and then further, all your money's in a 401k plan, and I won't get paid to provide advice to you for that.
Yes, no, this is really a challenge in the industry, and I think the financial industry has done a great job in terms of providing services, for a certain cohort of people. And a lot of I think one of the misnomers is that, we generally think that people who have higher assets have more complicated situations. They're the ones who need the tailored level of support. And, I think as we've looked through our data, I think that we just inherently just disagree. I think we really feel as though planning and advice is something that is broadly needed within the industry. It's not so much around, if you're higher net worth, maybe it's taxes and more wealth planning aspects of it, estate planning. But, if you have lower assets, we're still trying to make sure that we can get more savings going. So maybe it's budgeting. Maybe it's really making sure that we can get, a debt management program, or, making sure we're dealing with credit cards effectively so that we can free up. In our report, which was, again, a pretty interesting number, 40% of people, or just under 40% of people, are paying the minimum of their credit card debt. So that financial instability that a large portion of people have is just not something that can really be addressed. Yeah. And so that's really where the employer plans, like these 401k plans, really can sort of shed a light on this, because it's almost a different business model when you basically bring these financial advisory services into a 401k plan, because they are designed to help everybody and they're tailored to people. So if we have to deal with budget management, let's deal with that. If we have to deal with estate planning, let's deal with that. It's a unique way, actually, of being able to provide a broad range of services to individuals. Right now, I just don't think the individuals know that those services are available through their 401k plans, and that really is a source of advice.
Yeah. Chris, maybe you could talk quickly about the notion of financial wellness programs that are being introduced by employers and the need for people to avail themselves of these services if they have them as a benefit.
100%. So your employee, I would say, and I worked as an employer, as a sponsor for a long time, most employers offer a lot of programs that individuals just don't know exist. Your first point of kind of connectivity is not to say, oh, let me see what my company offers. But the reality is they actually do offer a lot. Financial wellness programs are tremendously helpful because they help you think holistically around what's going on in your financial lives. Again, to the point, maybe it's budgeting. Maybe that's a challenge. I just can't figure out how to sort of navigate all of the sort of the growth in my, I almost call it life creep at times. Like you're sort of going through different phases of your life, and all of a sudden now you've got another 8 expenses that you really didn't think that you were going to have and didn't plan for 5 years ago. How do you deal with that? How do you budget that? So these financial wellness programs are really core. And I know education, it's, can we really educate our way through this problem? It is one of the really critical factors, as well, again, helping people make informed, educated decisions about their finances that can really, again, propel the next, all the decisions that they have to make along the way.
Chris, unfortunately, we have to take a short break, but first we're going to answer a reader question in a segment we call Ask Bob. And the reader's question goes like this. The Federal Reserve lowered the interest rate back in September, but I don't get the difference between the Fed funds rate and the discount rate. And the answer is simple. The federal funds rate and the discount rate are both interest rates set by the Federal Reserve, but they serve different purposes in the U.S. financial system. The Fed funds rate is the interest rate at which banks and credit unions lend reserve balances to other depository institutions overnight. The discount rate is the interest rate that the Federal Reserve charges commercial banks and other depository institutions when they borrow funds directly from the Fed's discount window. Welcome back to Decoding Retirement. I'm talking with Chris Ceder from Goldman Sachs. Chris, when we took a break there, we left off and we were talking about investments and trying to make sure that people are taking advantage of all the opportunities that are out there. Oftentimes when people start working and they enter the 401k, they start out with a target date fund, but increasingly there are new investments that people could take advantage of, alternative investments, private credit, private equity, even managed account services. What do people need to know about all these other new opportunities?
Yeah, no, the nice thing is that there's a fair amount of innovation going on in the DC space. So, target date funds have been fantastic for a lot of people. I always say that they solved a very basic question. Early days, we used to educate people on what's the difference between a bond and a stock. And, we really don't do that anymore. So people who need sort of that solution that's really going to help them manage a kind of a portfolio, target dates have done a great job. Where I think the evolution is now taking place is that we're starting to realize and that, not every person is the same. So again, not every 45-year-old, some have savings, some don't have savings, some have other aspects. So the target date fund is helpful and it sort of, provides a good resource. But then personalization is really now a big part of the equation. So how will we really personalize that experience, personalizing the investment? So again, that we can account for the fact that, again, if you don't have savings, maybe you need a portfolio that is going to be a little bit higher risk because we're right now we're in catch-up mode. And at the same time, maybe you have, again, inheritance, and all of a sudden your now savings is ahead of schedule. That's another example. Maybe we don't need to take the same level of risk. So there's reasons for us to basically say where we can push on the gas and push on the brake when we think about that portfolio to help ensure that people are actually managing their money towards a particular retirement date. So that's a really important innovation. There's lots of focus on that across the industry, but really personalizing the experience and helping to make sure that what we're doing is resonating with the person's circumstances is very important.
Yeah.
A couple of other innovations just to sort of highlight, you mentioned, again, alternatives, so private credit, private equity, private real estate. This also is an area that there's considerable focus on, again, within the industry, because, again, the focus has been, as we highlight in the report, the challenge is with competing priorities is it's very difficult to save as much as we ultimately want to save. And so, the rules of thumb is that, an individual saves really 15% from age 25 to 65, and that ultimately, plus investment returns, is what gets you to retirement savings, to have sufficient savings. And so the challenge is if we really can't get to those levels of savings, particularly at lower income levels, well, what can we do? And there really is more opportunity to have more sophisticated portfolios that are not necessarily sophisticated that the investor needs to understand, but under the hood, more multi-asset solutions where some of these higher returning alternative classes could actually be an option that actually bring basically the overall return higher. And we've calculated some numbers. An additional 50% of return on a multi-asset portfolio basically is the same as saving 1%. So again, really kind of shows that can plan sponsors, plan advisors, can we do more to create portfolios that are going to basically be positioned for the long term? Because we know that we need to help alleviate some of the pressure on the savings side.
Yeah. I'm curious if you could address this. I'm a big fan of the life cycle finance theory, the work of Moshe Milevsky, who wrote Are You a Stock or a Bond? And some recent research by Morningstar where they looked at this notion of we need to incorporate RSUs, restricted stock units, and your human capital into the portfolio asset allocation discussion so that you're further improving the opportunity for risk-adjusted returns.
Yeah. No, I mean, it's 100% the direction of flow within the industry. So, again, when we think about sort of these target date funds, I mean, they're generally designed for the averages. There are, instances of custom target date funds where, again, maybe a workforce that is a little bit different. Maybe they have, a lower life expectancy than others, depending upon, there are adjustments that made. But when we think about portfolios, we need to be thinking more around all the other assets that they have, whether it's equity, RSUs, a pension benefit that they have, other aspects, those are just coming from the employer. But again, maybe you have rental income. All of those factors really should come into play when we think about what portfolio you have. Because again, if you have, there's, different rules of thought here. Maybe if you have a pension benefit and I know that you've got a guaranteed source of income, maybe my portfolio can actually take on more risk because, I can afford that, which ultimately could help shore up some of the gaps. On the flip side, maybe it's going to be the opposite. But understanding what all of those assets are and why on some level some of those aggregating services where it can pull the full financial picture together for people is actually really important because the more we know about all those different sources of income that are going to play a role in retirement, the more precise we can actually build a portfolio that's going to basically be individualized and really for that person's needs.
Right. So what role does Robo advice or AI play in this?
Certainly, robo advice is going to play a really important, component. And whether we call it robo advice or, in the 401k industry, we generally call these managed accounts. I would say they're not inherently robo advisors, because what they're doing is they're bringing personalized investment solutions along with the planning aspects. So how we can integrate that notion of giving people a personalized plan. Really, once you have the plan, then the question becomes, well, how do I implement it? A target date may actually be the right answer. If everything is on track, that person may not need to, pay more for, a more personalized portfolio. That could be a great option for them. On the flip side, if they're off track, if they're behind, maybe we need a more personalized solution to help get them to be on track, and it becomes more of that solution. So the reason we talk about sort of a digitally enabled process is because, particularly as you talk in 401k plans, scale is really important. Financial advisors can provide this level of service to individuals, and they do a great job. But if you had to provide it to 500 people, 600, 1,000, all of a sudden you can't really provide that same level of guidance and advice, and in particular planning. So that's where the technology really comes in to be able to offer the service that everybody has access to, and then there's connectivity to an advisor to help talk through maybe more unique situations.
Yeah.
AI is a little bit of a different animal, because the question in my mind around whether AI and we can provide financial advice in a 401k plan with the regulations that we have to live with is harder. But certainly how we can help people navigate questions, how we can help them understand what their options are. We can help, from a financial advisor perspective, we can help craft emails, we can help prospect. I'm sure it's already in the process today.
Yeah. So I often think that saving for retirement is the easy part. Converting those assets into income in retirement is the hard part, because I have to worry about RMDs and IRMA and making sure that my money lasts a lifetime, et cetera, et cetera. Any thoughts about what people need to approach the converting assets into income question?
100%. We're very focused on, how you do that. Really, again, when you think about converting assets, again, I start with that plan, because really what you need to do first is you got to take stock, like where is all that income going to come from? And you're starting to really, it's almost like a layered approach. Like, so Social Security will be 100% part of that equation. Who do we need to provide the support for? Then you start to layer in, 401k savings, other savings, maybe, a checking account. Maybe you have other different, maybe properties, or grandparents may be supporting some aspects. So it's where does all that money coming from is very individual. And that's step one. And then you actually have to figure out, like, well, how am I going to actually pay for all the things I need to pay for? What's my lifestyle? So that conversion process is 100% how the industry is focused. There are many more guaranteed income versions coming into the market. I think it's still early days to see how effective they're going to be. But if you think about what different people need, there's certainly a cohort of people who are really going to benefit from guaranteed income options.
Yeah. Chris, unfortunately, time has run out. I want to thank you for sharing your knowledge and wisdom with us. It's so greatly appreciated. Thank you. Up next, we're going to answer a reader question in a segment that we call Ask Bob. And the reader's question goes like this. I received notice from the Social Security Administration that I'm subject to the income-related monthly adjustment amount for my Part B and Part D premium. What is that? Well, in essence, what's called IRMA is an additional charge on Medicare Part B and Part D premiums for individuals with higher incomes. Social Security uses information from your tax return filed with the IRS 2 years prior to determine if you are subject to IRMA. So, for example, your 2024 Medicare premiums will be based on your 2022 tax return. And you'll need to pay these additional amounts for as long as your income remains above the threshold. So if you've got questions about money or retirement, I'm here to help. Send them to AskBob@Yahoo Finance, and we'll answer them in future episodes. So that's it for this week's episode of Decoding Retirement. We hope we provided you with some actionable advice to help you better plan for or live in retirement. And don't forget, for the latest retirement news and expert analysis, check out yahoofinance.com.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.